Hello, it's a pretty lovely good evening once again from here in Delhi, and hope as always that each one of you are absolutely fine, happy, and of course in fine spirits. So today we are starting the journey with this particular chapter. This is going to be a very heavy, important, formidable chapter. I need to require to talk about it. That is Ind AS 103, of course, corresponds to International Financial Reporting Standard 3. Yes, we are talking about business combination and corporate restructuring. As promised, we are going to cover each and every gamut. It goes without saying, no doubt about that. And these are the topics which of course, we are going to cover up. And initially, we are going to pick up some concept dossiers. And before we come to the concept dossier, let me actually start the session with some general facts. So because I have seen through my experience actually that most of the student fraternity sometimes get confused. So in order to erase that particular confusion, first of all, let's have a look over this particular concept, correct? So if you are ready, and I would love you to actually just pull out your pen, pencil, sheets and take the classes very seriously. That's very important if you really want to get the maximum mileage out of it, correct? So we start the topic Ind AS 103, but without what we call letting you know what exactly we mean by business combination, what's the objective, and what are the intricacies and provisions of this particular Ind AS, we are going to take up some significant facts. What I mean by some significant facts. Just have a look over here. Let's presume that there is an entity by the name of E1, and this entity has investment in S1, in entity S1, and the investment in equity shares of S1 ranges from 1 to 19%. Suppose if this entity 1 has invested in 15% equity shares of S1 entity, so in this case, first of all, you need to understand that E1 will be called as investor because E1 has invested in the other entity, and quite obviously S1 will be known as investing entity. At this particular level, it doesn't look nice to actually talk about such what we call facts, but still, correct, we simply love to actually start from the scratches. So as I told you, this time the investment made by entity is ranging from 1 to 19%, you presume 8%, 15%, 16%, whatever it is. So if my investment in other entities in between 1 to 19%, in that particular case, first of all, you need to understand at this particular level that these are considered as simple normal investments. Correct? It will be treated as normal investments. First of all, you need to understand this particular point. These all are by handwritten notes, so of course, and these are in type form because of late what we have realizing that students do not simply want that we should write each and everything. In fact, they love to actually simply get the understanding, conceptual understanding. So that's the reason I am not interested in wasting the time. So that's why the notes are written before you. I am simply going to actually present the analysis of the same. Correct? So this will be termed as normal investment. An important thing at this particular point, you need to understand that in this case, investor company E1 shall account it as per Ind AS 109, correct, in its separate financial statement. That means whatever investment I have made in the investing company, I will do the accounting only in my separate financial statement in the light of Ind AS 109. And Ind AS 109 simply states that investment should be recorded at fair value. Is it clear to you or not? However, another question is that in this case, no question of consolidated financial will arise. That means E1 entity, it has invested in between 1 to 19% in S1. So in this case, we need not require to actually prepare consolidated financial statement. Only thing is that whatever investment which we have made in S1 Limited, we have to do the accounting for the same, and we are going to record that particular investment in S1 Limited as per Ind AS 109 in our separate financials. Is it clear to you or not? Now, just pay attention down towards point number B. Now here what we have picked up that there is an entity E2. Now this time the investment made by this particular entity is more than 20% or more, but less than 50%. Investment is 20% or more, but less than 50% in entity S2. Needless to say that E2 is invested this time. S2 of course will remain investing company. Number one. Importantly, in this particular case, you need to understand because this time range of my investment is 20% or more, but less than 50%. Let us say I have invested in 35% stakes of S2. So that is falling in between 20% to 50%. So in this case, other entity S2 will be considered as our associate entity. So first of all, you need to understand this particular point. Second important point you need to understand is that investor companies shall have to prepare, in this case, two types of financial statement. One separate financial statement and another one consolidated financial statement. Reason being is that this time our investment is more than 20%, of course, and less than 50%. Indirectly, it means we are exercising significant influence in the other entity. Other entity will be considered as our associate entity, as I just told you, and in this case, we means the investor entity will have to prepare two types of financials. One separate financial statement, and another one is consolidated financial statement. Another point which you need to understand here is that investor company E2 this time will account its investments in S2 Limited as per Ind AS 27. Correct? This time you have to keep that particular point in your mind. What are the provisions of Ind AS 27 that I will talk about later on, but for the time being, I can simply tell you that AS 27 simply states that if you have made the investment in your associate, then you have the choice to show the investment either at cost or as per Ind AS 109, that is at fair value. Correct? So investor entity E2 this time will account it as per Ind AS 27. In its separate financial statement. And besides that, because other entity this time is our associate entity, so we have to prepare this time consolidated financial statement. But this time the consolidated financial statement shall be prepared as per Ind AS 28. So as a professional student, you need to know actually all these things at great, what we call, length. Is it clear to you or not? So if your investment ranges between 20% or more, but less than 50%, then your other entity will be what we call associate company, and you would be considered as if exercising significant influence over the other entity. In this case, you will have to prepare two types of financial statement. One, as I just told you, a separate financial statement, and another one is what we call consolidated financial statement. In your separate financial statement, you are going to record your investment in investee entity in the light of what we call Ind AS 27, which simply states that investment should be recorded either at cost or at or what we call as per the provisions of Ind AS 109. Ind AS 27 states that investment made by the investor entity in the other entity can be recorded either at cost or as per Ind AS 109. Indirectly, it means at fair value. Is it clear to you or not? And secondly, you will have to prepare the consolidated financial statement in this particular case, but the consolidated financial statement shall be prepared as per the provisions of Ind AS 28. So these are the points which, as a professional student, one must know. Then point number C we come over to. Now this time I have taken a case that entity E3 is there and its investment in other entity, let us say S3, is more than 50%. So let us say 60%, 70%, 80%. Quite obviously, as you know better than I, that if our investment is more than 50%, quite obviously, in this case, we are exercising the control over the other entity. Is it clear to you? Because this time we are exercising the control over the other entity. So other entity this time, besides being an investee entity, will also be known as our subsidiary company, because now we have obtained the control over the other entity. Is it clear to you or not? Number one. Number two, in this case, E3 will be known as investor. Besides that, it will be considered as a parent company. Is it clear to you or not? So that means this time the relationship between these two entities is of parent and subsidiary. So if you are exercising the control over the other entity will be your subsidiary, you are the parent company. In this case, again, you are going to and you are supposed to prepare two types of financial statements, separate financial statement and consolidated financial statement. Similar to the earlier what we call version. In this case also, when you are going to record your investment in your subsidiary company, in your separate financial statement, you will record it as per the provisions of AS 27. AS 27 simply states that investments in associate or in subsidiary can be recorded at cost or as per Ind AS 109, that means at fair value. Is it clear to you? So this time you will record the what we call your investment in subsidiary company in your separate financial statement in the light of Ind AS 27, number one. And this time you will have to prepare the consolidated financial statement. However, here you have to keep an extra what we call eye, what I am going to let you know now. This time parent company will prepare the consolidated financial statement, but it will prepare the consolidated financial statement, one, on the date of acquisition as per Ind AS 103. And secondly, at the end of the year and subsequent year ends in the light of Ind AS 110. Now, this is the point which most of us get confused of it, so I have tried to actually now explain it. Now, you must understand that when Ind AS 103 applies and when what we call Ind AS 110 will come into play. So, this time parent company will have to prepare the consolidated financial statement also. And consolidated financial statement is prepared on the date of acquisition, that means the date on which we get the control or obtain the control of over the other entity. So on the date of acquisition, whenever parent would prepare the consolidated financial statement, that would be prepared as per Ind AS 103. But subsequently at year end, whenever the parent will prepare the what we call consolidated financial, then it will be prepared in the light of Ind AS 110. That point should be covered clearly now. So this is the point actually which I have written. If our investment is more than 50% in the equity shares of other entity, quite obviously in this case E3 is investor. Besides that, it is known as parent company, holding company or acquirer entity, while S2 will be called as investee entity and it is our subsidiary company or acquiring company. Is it clear to you? Of course, in this case we have the control, correct, because we have the majority stakes. And importantly, investor companies shall have to prepare separate financial statement and consolidated financial statement. Is it clear to you or not? This line unnecessarily got printed, you cut it out. So investor companies shall have to prepare separate financial statement and consolidated financial statement. Just a moment, I told you. And I also told you that separate financial statement shall be prepared in the light of AS 27. Separate financial statement shall be prepared here means that in the separate financial statement, parent will record the investments made by it in the what we call subsidiary company in the light of AS 27, either at cost or as per what we call Ind AS 109, which simply states that investment should be recorded at fair value. Now, consolidated financial statement, as I just told you, on the date of acquisition shall be prepared in the light of Ind AS 103, while subsequently at the year end and subsequent year end, whenever we are going to prepare the consolidated financial statement, we will have to follow the what we call Ind AS 110. So now, the application of Ind AS 103 and application of Ind AS 110 should be absolutely clear, correct? And now there is another point I have written, although this point at this particular moment is not needed, but just for the sake of understanding, suppose there is an entity E4 and it has got 30% of investment, let us say in a joint arrangement. We will study joint arrangement later on under Ind AS 111. But just for the sake of simple understanding, joint arrangement we will see later on could be in the form of joint operation or joint venture. Correct? Suppose if E4 has invested in a joint arrangement and joint arrangement is in the nature of joint operation. In this case, entity E4 will account its investment which it has made in the joint operation as per Ind AS 111 in separate financial statement only, and no consolidated financial statement would be required. We will see later on when we will do Ind AS 111. This is so because why consolidated financial statements are not required in this case, because we will see that joint operation is not a sort of corporate form of organization. That could be, or not a structured form of organization. That could be the most logical possible reason behind that. Is it clear to you or not? So if it is clear, what I said that if suppose entity A has made some investments, let us say 30% investment in a joint arrangement, and joint arrangement is a joint operation. In that particular case, the investor entity will account such investment as per the provisions of what we call Ind AS 111 and in separate financial statement, and no consolidated financial statements are required in this particular case. However, if joint arrangement is in the form of joint venture, we will see when we will study under Ind AS 111 that joint venture basically is a sort of a structured organization, sort of corporate, you can say. Now, in this case, E4, quite obviously, will prepare the separate financial statement, but as per Ind AS 27. That means whatever investment which we have made in the joint venture, those investment will be recorded in the separate financial statement as per Ind AS 27. Correct? And besides that, we have to prepare this time consolidated financial statement, but consolidated financial statement shall be prepared AS 28. While going through this panorama of what we call different sort of facts, you must have noticed one important point, that unless and until we shall acquire control of other enterprise, correct, neither Ind AS 103 will come into play, and nor Ind AS 110 will come into play. Is it clear to you or not? You must have noticed this particular fact. If you haven't, then you must note. Now, here I have also mentioned provisions of AS 27, which I have already explained. Simply, accounting treatment of investment in subsidiaries. Suppose if you are a parent company and you have a subsidiary company, or if you are a parent, if you are an investor and you have an associate entity, or if you are an investor and you have a joint arrangement. As we have seen that in such cases, we have to prepare the separate financial statement as per Ind AS 27. Correct? If I am investor entity, I am having a subsidiary company. If I am an investor entity, I am having an associate. If I am an investor entity, I am having a joint arrangement. Correct? In that particular case, I will have to prepare a separate financial statement as per Ind AS 27. Now, Ind AS 27 simply actually states that investor company can reflect its investments at cost or at fair value, that is fair value through profit or loss account or fair value through other comprehensive income. Now, these two terms, fair value through profit or loss account and fair value through other comprehensive income, we will study under Ind AS 109. That means AS 27 has thrown a sort of what we call discretion or choice that investor entity can reflect its investment either at cost or at fair value through profit or loss account or fair value through other comprehensive income. And these are the things, these provisions are contained under Ind AS 109. Correct? Further, AS 27 also states that whatever investment have been made by the investor in the other entity, obviously the investment will fetch you some returns. So those returns should be recorded in the profit or loss account while preparing the separate financial statement. Any dividend income received from such investment is going to be recognized in profit or loss account in separate financial statement. These are the provisions of AS 27. Correct? So now further you need to understand that what we mean by group. A group could be, if you are an investor and you are having a subsidiary, so it is a group of parent and subsidiary. We may so combinedly parent company and subsidiary company or subsidiaries company. I may have more than one subsidiary company. So investor and its subsidiary will definitely form a group. Likewise, if I am an investor and I have an associate, other entity could be my associate only if my investment is 20% or more but less than 50%. Remember one thing. So even in this case, it will form a group. And similarly, if investor has invested in a joint arrangement, then again, it is going to form a group. So a group you can say is combination of what we call parent company and subsidiary company, or parent company or investor and associate, or investor and joint arrangements. Is it clear to you or not? Now we come to the what we call slowly and steadily towards what we are actually pursuing to achieve. That is business combination. Quite obviously, a business combination will arise when an entity will acquire the control over the business of the other entity. And how can you acquire the control? Generally, control is acquired by way of majority stakes. No doubt about that. If suppose I am going to have investment of more than 50% in the what we call stakes of other entity, quite obviously, indirectly, it means now I am exercising the control over that particular entity. So business combination will arise when a company will acquire the control over the business of the other entity. You need to understand, first of all, this particular point. Second important point is that Ind AS has defined business. It is very important that when you are going to acquire the control of the other entity must meet the definition of the business. Now, what we mean by business actually, Ind AS has simply stated that basically business simply means integrated set of some activities, and it must have it must have three elements. One is input, another one is processes, and last one is output. Now, what we mean by input? Input actually, you can simply say input means resources and assets which are needed to generate the output. Correct? Suppose I'm going to acquire the control of a particular entity. Quite obviously, I'm going to get control of its resources, assets. So that entity must have what we call some assets, resources in the sense like property, plant and equipment, intangible asset, manpower, etc. Correct? So those resources, that entity must have resources and assets so that we are in a position to what we call generate output by utilizing those resources. This is what we mean by input. That means that particular entity must possess some resources. Second element is processes. Now, processes simply refers to the technique and the knowledge. Suppose if I'm going to acquire your business, let us say I'm able to acquire what we call your assets, your all the property, plant and equipments, your intangible assets and your manpower. But if I do not have the what we call required technologies and required expertise and required know-how, then I cannot what we call use that along with the inputs. That is the point is. So that means that other business must possess some processes. So if I'm acquiring your entity, indirectly it means I am acquiring your inputs, your processes, so that by acquiring the processes, I can use the resources. Is it clear to you? And last one is output. Output simply refers to the capability of the entity or the business to generate the what we call output. Capability to generate the output. Even though your business right now may not be generating a revenue, but if it has got the capability, that means this criteria will be satisfied. So that means if I'm going to acquire the control over the business of the other entity, indirectly it means that your entity must meet these three parameters. Your entity must have the required resources and asset to generate the output, correct? Your entity must have the required sort of processes so that processes can be what we call applied over the resources, can be combined with them, can be integrated with them. And finally, by combining the processes with the input, we should be in a position to generate the output or revenue. So these three elements must possess. Remember one thing. If let us say I'm going to acquire the control of a particular entity, if these three elements are not met, or these three criteria are not met, or the definition of business is not met, in that particular case, Ind AS 103 will not apply, will not come into play. We have kept a separate sections on it where near about 10 or 15 case studies we are going to take. But right now, for this particular movement, you should know what is the meaning of business. It is important that when we say that we are having control over the other enterprises, or we are obtaining the control of the business of other entity, then what we mean by business. Is it clear to you? Second point is that just a moment ago, I told you that we are getting control over the other enterprise. Generally, in practical life, you can get control over the business of the other enterprise simply by acquiring more than 50% stakes in that particular entity. Suppose if you have got more than 50% stakes of the other entity, quite obviously you will have the control. In this case, I have already told you, you will be termed as acquirer company, correct, or parent company. And you are supposed to prepare separate financial statement as per Ind AS 27. You are supposed to prepare consolidated financial statement on the date of acquisition in the light of Ind AS 103. And besides that, which will be our next chapter, you are supposed to prepare consolidated financial statement at the year end as per Ind AS 110. On the date of acquisition, when you are going to get control, you are going to prepare consolidated financial statement in the light of Ind AS 103, as I said, when you will reach the year end and subsequent year end and even year end later. So then you are supposed to prepare what we call CFS on the basis of Ind AS 110. Is it clear to you or not? One need to keep an eye that you can get the control of the other entity by what we call acquiring more than 50% stakes in that particular entity. That is definitely one part. But the second part is sometime we can get the control of the other entity by simply acquiring all the net assets. Now, in this case, indirectly here, it means I'm purchasing their net assets of the other company. Indirectly, it means in this scenario, what is happening? The acquiring company will lose its existence. When I have purchased all the assets and liabilities, see, there is a difference between two things. If suppose I have made an investment of, let us say, 75% in the other entity, here I am not purchasing your assets or liability. Remember one thing, I am simply acquiring what we call your assets and liability. This time, the existence of the acquiring company will not come to an end. It will continue to function and operate. That's a different matter. It will continue to function and operate as per the direction which we would deliver, because that particular entity is now under our control. However, when we are going to purchase your net assets, quite obviously now the existence of your company will come to an end. So that is what I have written here. In this scenario, acquiring company shall come to an end, shall cease to exist. An acquiring company will account the business combination. Acquirer company this time, parent company will account the business combination in separate financial statement, and because acquiring company is no more, you cannot prepare the consolidated financial statement in this case. Is it clear to you? So in this case, you need not require to prepare consolidated financial statement if you are going to purchase the net assets of the other company. Is it clear? So there is a difference between acquiring control and acquisition of net assets of the other company. Quite obviously, now the next thing is which is quite important, accounting for business combination. First of all, whenever we are going to obtain the control over the other entity, now we are the acquirer company. In this particular chapter, instead of saying parent, I would say acquirer company, and quite obviously the other company will be termed as acquiring company. And the method which we are going to adopt for accounting will be known as acquisition method. Is it clear to you? So Ind AS 103 will provide, of course, some guidelines for business combination in consolidated financial statement of acquirer company on the date of acquisition. That means on the date of acquisition, as I just told you, as per Ind AS 3, acquirer company will have to prepare the consolidated financial statement. How it is going to prepare, some guidelines have been provided by this particular standard. Is it clear to you or not? Now, the first step, sometimes this step may appear to the student fraternity. What sort of this step is? The first step is identifying the acquirer. Now, some of you may wonder actually why this step is needed so much of discussion. Correct? Now, suppose there is an entity. First of all, let us presume that current accounting year starts from 1/4/2023, ends on 31st of 3/2024. Correct? We presume this way around. Let us say A1 acquires control of the other entity on 1/7/2023. It got control because it acquired, let us say, 65% stakes in this particular entity. Correct? Let us say this is A2 entity. So on this date, we acquired 65% stakes in A2 Limited. Quite obviously, now on this particular date, it would be said that company A1 has got the control. Is it clear to you? And this date will be termed as date of acquisition. Now, because I am simply saying that A1 has got the control, or A1 has acquired 65% stakes of A2, so quite obviously some of you may say, sir, in this case, we can directly say that this is the acquirer company. You are not wrong at all. This is acquirer company. And this is acquiring company. Because now A1 has got the control, quite obviously, because A has acquired the stakes, and at more than 50% stakes. So quite obviously, it seems that control is now in the hands of the A1. So A1 should be considered as acquirer company and acquiring company. Now, under the first step, we have written that for each business combination, correct? For each business combination, one of the combining entity shall be regarded as acquirer company and other entity shall be regarded as acquirer entity. This is what standard says. The point is that, sir, it looks so simple. Why standard is actually telling that one entity should be regarded as acquirer, one entity should be regarded as acquiree? It is quite simple. The entity which is getting the control of the other enterprise is acquirer company. You are absolutely right. It looks very simple, but try to understand in this case. Suppose if I am acquiring 65% stakes in the other entity, technically I am the acquirer. Actually, this time I will be termed as I am the legal acquirer, while the other entity will be termed as legal acquiree. Legal acquiree. Correct? That means in the eyes of the law, obviously A1 will become the legal acquirer because it has got 65% stakes in the other entity. And in the eyes of the law, A2 will be considered as legal acquiree company. However, on some rare occasions, it may happen, I am talking about, for the purpose of accounting, acquirer company may not be considered as accounting acquirer. Are you getting my point or not? So there are two different connotations which we need to understand here. One is legal acquirer and one is legal acquiree. And another term which we are going to use is accounting acquirer and accounting acquiree. Accounting acquirer and accounting acquiree. You need to actually acclimatize yourself with these two terms. That is very important. Accounting acquirer and accounting acquiree. Why these terms are important? First of all, let me tell you. Because accounting will always be done in the books of accounting acquirer. 99.99% legal acquirer generally happens to be the accounting acquirer. without an iota of doubt. 99.99% always legal acquirer will be your accounting acquirer, and you need not require to stretch your mind to what we call vagabond limits to unnecessarily figure out actually which company is the accounting acquirer. It will be very simple, correct? However, as I told you, on rare occasions, sometime it may happen that legal acquirer may not be the accounting acquirer. Indirectly, what I am trying to tell you, that legal acquiree sometime could be accounting acquirer. Legal acquiree company sometime could be considered as acquirer for the purpose of accounting. When such a situation would arise, it is known as reverse acquisition. It is a case of then reverse acquisition. It is known as reverse acquisition, and we have discussed this particular point at great length with lots of case studies later on. But just to make the point clear, why standard says that under the first step, you need to first of all figure out who is the acquirer. Indirectly, standard is saying that you have to figure out who will be considered as acquirer for the purpose of accounting. For the purpose of accounting, as I told you, because sometime on rarest of rare situation, it could be a possibility that legal acquirer may not be what we call accounting acquirer. For example, let us say, just stretching this particular case a wee bit further. Let us say A has acquired more than 50% stakes in this particular company. I've already told you 65%. So superficially, it seems that now control is in the hands of the what we call A1. However, let us say further, if I give you one more statement, that company A1 acquired 60% control over A2, 65% stakes in A2. However, with mutual consensus, it was agreed that company A2 will take charge of all the relevant activities of the business. Now, because company A2 will take charge of all the relevant activities of the business, so this time, in real terms, we may say control actually is in the hands of A2, even though we have acquired more than what we call 50% stakes. So when there would be some agreements between two companies, it could be a possibility that in such a situation, just your majority stake will not be suffice to actually provide you the control. Is it clear to you? So sometime it happens that legal acquirer may not be the accounting acquirer, and such a situation is known as reverse acquisition. So now coming back to the important point, because we are going to do lots of questions later on reverse acquisition, then this particular point will become further clear. At this particular point, we are simply trying to find out what are the steps which we may have to follow while doing the accounting. The first step is actually identifying the acquirer. This step simply means basically we have to determine who is going to be the accounting acquirer, and this is not going to be a tough task. I have already told you, because in most of the question you will be given only this much of a statement that company A has acquired 70% stakes in the other company. So in this case, A will be legal acquirer, A will also be the accounting acquirer, correct? Now coming over to the second point. Now the second point under the accounting steps I'm talking about, once you have determined out of the scenario who is going to be the accounting acquirer, then the next point is determination of acquisition date. Generally, the acquisition date will be considered as the date on which the acquired company is going to obtain the control of the acquiree, and generally this date is considered as the date when the acquirer legally going to transfer the consideration to the acquiring company, and he would acquire the assets and assumes the liability of the acquiring company. Correct? For example, going back to the example which I just wrote earlier, that on 1st of July we got the control, indirectly means on this date we are legally going to transfer the consideration to the other entity, and we are going to assume their assets and liability on this particular date. So generally date of control is one when actually we obtains the control by legally transferring the consideration and assuming the assets and liability. But sometime date of control may not be this particular date which I just mentioned. And this generally happens when we require the approval of government or some what we call regulatory authority. So in that particular case, the date on which we are going to get the approval or the sanction from the required authority or the government, that particular date will be considered as date of acquisition. This is the point which you need to actually keep in your mind. Now, the third point is, Let us say we have determined who is going to be the acquirer, who is the acquiree, and let us say date of control is absolutely clear, and let us say this is the date of control. So if date of control has been determined, now the next step is obviously determination of purchase consideration, because we are going to give some consideration to the other entity, correct? In lieu of getting the control of that particular entity. Logically, unless and until we would give the purchase consideration, we cannot get the control, honestly speaking. So that is why it becomes very important that what will be the amount of purchase consideration. To be very honest with you, 99.99% it would be given in the examination. However, sometime on rare occasions, especially in a full length question, long question, you may have to compute the purchase consideration. Otherwise, 90% it would be given, and 10%, especially in the long question, very long question, advanced level, highly advanced level question, you may have to compute the amount of purchase consideration. Besides that, some concept-based question, let us say 3-4 mark question, may be asked wherein they would ask you to compute the amount of purchase consideration. Generally, the amount of purchase consideration will be given in the question, but in long advanced question, you may have to compute the purchase consideration, and sometimes the question will simply ask you to compute the amount of purchase consideration. So what we mean by purchase consideration? In order to compute the amount of purchase consideration basically means actually the amount which you are going to pay to the owners of the acquiring company to obtain the control, no doubt about that. And purchase consideration, in order to compute, actually, you have to see to it that how much cash you have paid, and then you are going to consider the fair value of the asset transferred, fair value of equity shares issued. In case if you have issued some debenture, you will take the fair value of the debentures. These are quite easy, no problem. Whatever cash we have paid, whatever fair value of the assets we have transferred, because in order to pay the purchase consideration, we can discharge the purchase consideration by way of cash, by transferring our assets or by transferring our equity shares or debentures, correct? These are the easy things, but there are some complicated things. For example, present value of deferred consideration, present value of contingent consideration, and fair value of employee stock option plan, correct? Relating to pre-combination period in respect of replacement awards, correct? So by adding all these things, we will get the amount of purchase consideration. Number one, that means in order to compute the purchase consideration, we should be deft, absolutely skillful in computing even the present value of deferred consideration, and that is not an easy task, fair value of contingent consideration, and we should be well oriented to tackle what we call how to compute the fair value of ESOP relating to the pre-combination period, and of course post-combination period, although post-combination period will not be a part of purchase consideration in respect of replacement award. That means we need to understand these three vital components. That is deferred consideration, contingent consideration, and replacement award. We have kept separate sections for that, correct? And over there, and remember one thing, almost in every examination, we see to it that one concept-based question is asked from deferred consideration or contingent consideration or replacement awards. So all the more it becomes motivating factor for us to know to actually pay extra attention towards the computation and acquirement of supreme amount of proficiency in it. These three concepts are very, very vital. Present value of deferred consideration. Present value of deferred consideration. Actually, you can say fair value. You can write fair value of deferred consideration. Now, what is the fair value of deferred consideration? That is present value of deferred consideration. Now, what is deferred consideration? We will talk about that later on. For example, today I have acquired the control over a particular entity. I may enter into an agreement with the acquiring company that I have some portion of the purchase consideration I will pay you today, and some portion of the purchase consideration I will defer it and I will pay it, let us say, after 2 years. So in that particular case, the amount which I have deferred, I will compute its present value and I will include it on the date of acquisition in the amount of purchase consideration. Then what is value of what we call contingent consideration? Contingent consideration means, let us say today I have got the control over a particular enterprise. Correct. Obviously, on this particular date, I will definitely give some consideration to that particular company. Besides that, I might actually enter into an agreement with the acquiring company that if you are going to function properly, regularly, in an efficient manner, and if you are going to achieve, let us say, some target which I am going to set before them, let us say I'm going to set a target before them that I have got the control of your enterprise, but still I would love you to actually give us a return of 10% almost every year. Or I will give them 2 years of time and I will say that in the next 2 years, return delivered by your company to us should be actually in the vicinity of 10%. So contingent consideration and deferred consideration, the difference here is that in case of deferred consideration, we simply say that we are going to pay you, let us say 30 lakh, 40 lakh after 2 years, 3 years from the date of acquisition. But in case of contingent consideration, we tell to the acquiring company, we will pay you some more amount, but that particular amount will be dependent upon some target, some specified what we call target and performance targets, it could be, or profit target it could be, but that will depend upon some what we call target or parameters. So if those parameters would be met, then only we will have to make the payment. But at the same time, whether the target would be met or not, that will be decided only after what we call 2-3 years. Let us say, today I tell to the acquiring company, I will pay you 20 lakhs more after 2 years period of time, provided after 2 years, return provided by your entity to us is 20%. Correct? So, in real terms, I'm supposed to pay the amount of consideration, contingent consideration after 2 years. But still, on the date of acquisition, in order to compute the amount of purchase consideration, I will include the present fair value of contingent consideration. I will compute the what we call fair value of contingent consideration, and in order to compute the fair value of the contingent consideration, generally we take the present value, honestly speaking. So, whatever present value is that, I will include it as provision for contingent consideration as a part of purchase consideration. That means on the date of acquisition, I will include the present value of contingent consideration. Correct? And let us say after 2 years, today I have included it as a part of purchase consideration. And after 2 years, let us say target is achieved. If target is achieved, then I am going to make them the payment. But if target is not achieved, then whatever provision which I made actually on the date of acquisition, because now 2 years have gone by, after 2 years, that provision I will take back to my profit and loss account. Is it clear to you or not? But we will talk about all these concepts later on, as I told you. And lots of questions I have kept separate sections for it. Is it clear to you? Present value, for example, if I will show you here, I have already told you. Now see here, I have kept separate topics for equity settled award of acquiring company. If you can have a look over here, just give me a second. What happens? Now, in this case, this is the topic wherein we are going to talk about replacement award, non-replacement award. And then, in this case, we have also kept separate topics for your reverse acquisition, as I was talking about. Then here, see, deferred consideration, contingent liability, pre-existing, and so many topics are there. So, actually, this topic, deferred consideration, contingent liability, you can expect some concept-based questions on it. Correct? So, that was the point. So third step is determination of purchase consideration. Now you should know one thing, that generally in normal question purchase consideration will always be given. However, on rare occasions you may have to compute purchase consideration even in the long question, if question is bit of what we call advanced level. But most of the time actually purchase consideration need to be computed only in respect of concept based questions. Correct? So sometime question may be simple, that simply compute the amount of purchase consideration, or sometime question may be only related to deferred consideration or to contingent consideration or to what we call computation of replacement rewards, etc. Is it clear? Now, presuming that everything is settled, correct, you have acquired the control over a particular enterprise, acquirer is determined, purchase consideration is known. Now the next step is obviously, now this standard says that your next step is that you will have to identify, recognize, and measure the assets and liability which you are going to take over of the acquiring company. Correct? So, standard is very clear and very simple. It states that whatever assets you are taking over and whatever liability you are assuming over, those assets and liability must be recorded at fair value. At fair value on the date of acquisition. Please pay attention. So whatever assets you are going to acquire, whatever liability you are going to acquire, you are going to what we call reflect them at fair value. That is the general rule. It is the general rule. Whenever I am going to acquire the control over the other enterprise, in that particular case, indirectly we are getting control of assets and liabilities. So we have to actually recognize them recognize and measure them at fair value. No doubt about that. 99.99% all the assets and liabilities which are taken over will be recorded at fair value on the date of acquisition. However, there are some exceptions also, or some special points in this regard. The special point, the first point I have already told you, all the assets and liability of the acquiring company taken over at fair value, we have to record. That is one thing. This is the general rule. However, there are some exceptions. For example, contingent liability of acquiring company. Suppose today I am going to take over the business of the other entity. Normally, what happens? I'm talking about that. Suppose I'm taking over the business of other entity and other entity is having a contingent liability. You know better than I actually what is a contingent liability. Contingent liability basically means present obligation. What we mean by present obligation? Present obligation means obligation on the reporting date. Present obligation means obligation on the reporting date. Obligation on the reporting date. That is very important. So, if on the reporting date an entity is having an obligation, but at the same time, if we feel that probability of outflow of funds is not there, so in that case, that liability is recognized as a contingent liability. And you know that contingent liability are not recorded within the financial statement. They are recorded as by way of notes or footnotes. Is it clear to you or not? So generally, when I am going to take over the business of other entity, because that contingent liability is not included in the financials, generally I am not going to take it over. That's the general rule. However, Ind AS 103 states that contingent liability of acquiring company will also be taken over. So that is why it becomes an exception. Is it clear to you? So generally it is not taken over, but in case of business combination, you will have to take it over and you will have to recognize as a liability and you will have to recognize it at fair value. Is it clear to you or not? Is it clear? So, that is why I have written it is an exception to the recognition principle, because generally contingent liability are not recognized. But in case of what we call business combination, we will have to take over the contingent liability, recognize it as a liability, and we will recognize it at fair value on the date of acquisition. You should be aware of this particular point. Second point is that such intangible asset that meet the recognition criteria as per Ind AS 38 but not recorded in acquiree's books are also taken over and recognized at fair value on the date of acquisition. Now, it could be a possibility. Let us say today you are acquiring a particular entity. It could be a possibility that that particular entity might not be following the Ind AS, but your entity follows Ind AS. That particular entity, before being taken over, was not following the what we call, let us say, Ind AS. And on account of that, it might have not recognized some intangible assets, you can say so. Is it clear to you? But now, when you are going to acquire that particular entity, and if you feel that there are some intangible assets and they are satisfying the recognition criteria which is laid out in Ind AS 38, so if you think that those intangible assets are what we call meeting the criteria for the recognition as per Ind AS 38, then you are going to recognize those assets, even though in the books of acquiring company those assets were not recognized. So this is another important point which you need to take care of. Sir, could you give us some example? Yes, surely. For example, examples are like internally generated customer relationship, internally developed patents, etc. So these are the examples which generally we come across. So generally, sometime acquiring company doesn't recognize the sort of what we call asset. So because of the fact, as I just told you, because they might be following what we call existing accounting standard. But now because we are the acquirer company, we are following the Ind AS, and that is the reason if we feel that these particular assets are recognizing the principles with respect to recognition of Ind AS 38. So in that particular case, we will have to recognize such assets. That is very important. Liabilities for income taxes due employee benefits shall also be taken over and recognized and measured as per provisions of relevant Ind AS. Now, this is considered as exception to both recognition and measurement principles. Suppose today I am going to acquire the business of a particular entity, and if that particular entity is having some what we call tax expenses due, or what we call, let us say, some employee benefits dues. Generally, I am not going to take those over, because generally there are some statutory provisions attached with what we call these things. So in order to avoid any complications, we avoid taking over the tax liability and the employee benefit liability in general life. However, in Ind AS, in case of business combination, you will take over what we call such liabilities. Correct? Number one. So that is why it becomes an exception to the recognition principle. And it becomes exception to the measurement principle. As I told you, most of the things which we assume are recorded at fair value. But here, we are going to record them as per the provisions of respective item. For example, Ind AS 12 deals with taxation, and employee benefits is covered by Ind AS 19. So as per the provisions of these standards, we are going to determine their value. Correct? And sometimes it happens that in business combination, there are concepts of deferred taxes, deferred liabilities. So that is the reason actually we will have to take over such liabilities. So these are the vital points which you need to do while doing the accounting. Correct? Similarly, indemnification assets promised by acquiring company shall also be taken over. Just a moment ago, if you remember, I told you, let us say I am taking over the business of this particular entity. Correct? Let us say this entity is A2 and I am A1. I am the acquirer company. This is the acquiring company. And let us say this company is having a contingent liability worth rupees 200 lakhs. So quite obviously, just a moment ago, I told you, even though it is a contingent liability, as per what we call, as per the books of AS2, quite obviously they haven't recorded it in there within the balance sheet, but it must be recorded. They must have noted it down as a sort of notes. But we will have to assume this liability and we will record it as a liability. So we have taken over their liability, let us say at 200 lakhs. Correct? Sometimes in practical life, what happens when this particular entity would acquire the business of this particular entity, acquirer company also knows that it is acquiring a liability which as a rule should not have been taken over. Even acquirer company knows that we are taking over a contingent liability. There is no point in taking over the contingent liability, but we are pressured by the what we call Ind AS 103, because we are taking control over the control of this particular enterprise. We will have to assume this particular liability now. So we have taken over this particular liability worth rupees 200 lakhs. So generally in practical life, what happens when we take the control of the other enterprise, we tell to the enterprise that we are taking over your liability unnecessarily. Now it is a sort of loss to us. So other entity, in order to keep the good business relations, sometimes promises us that in case if this liability would materialize in future, we will compensate you with some amount. Let us say this entity has told us that we will give you 150 lakh in case tomorrow, if let us say after some time, if this liability would what we call materialize. So this promised amount by the acquiring company to us is known as indemnification asset. Indemnification asset are sort of contingent asset, you can say so. So logically you must have seen that indemnification asset or contingent assets are not recognized. But here we will have to recognize them. So it is an exception to both, as I told you, recognition and measurement principle. So because at what amount we are going to reflect it, that sometimes depends upon the agreement. So not necessarily at fair value. So indemnification asset promised by the what we call acquiring company need to be recorded, and you have seen that it must be recognized first, and it will be recognized as per the agreed amounts. Is it clear to you? Second thing is, sometime we may come across non-current asset held for sale by acquiring company. Correct? As per the new formats, as per the new format, sometime what happens actually, if suppose we have kept an asset and we have kept this particular asset with an intention to sell in future, and if that particular asset is of non-current nature, we will call it as non-current asset held for sale. Such asset must be reflected as a separate line item under property, plant and equipment, no doubt about that, and Ind AS 105 deals with it, which you are going to study later on. So in a business combination, if acquiring company is having a non-current asset held for sale, it will also be taken over. But it will be recognized as per the provisions of Ind AS 105. And Ind AS 105 says that non-current asset held for sale will be recognized at fair value less cost of disposal. Is it clear to you? So at this value, so we can say it is an exception to the measurement principle, because general measurement principle is that we have to measure at fair value on the date of acquisition. However, non-current asset held for sale taken over shall be recognized, or shall be measured, should I say, at fair value less cost of disposal. Correct? In the light of Ind AS 105. Similarly, if we have already talked about earlier under purchase consideration that if acquiring company is having some share-based payment transaction, correct? So those payments, sometime we will have those agreements, sometime we are forced to take over, and then those will be measured as per Ind AS 102 that we are going to study, as I told you, under replacement award, etc. And there is another point here, reacquired right shall be taken over and recognized at fair value. What we mean by reacquired right? Let us say our company is in technological sector and we are a big name, correct? Our technology is quite famous and we have, let us say, licensed our technology to some particular entity, let us say for 10 years. But after 2 years, we acquired that particular franchise. We acquired that particular entity. So indirectly it means whatever right I gave them earlier, I am reacquiring it. So reacquired right will also be taken over and will be recognized at fair value. So while doing the accounting, this is the major step. When you are going to take over the assets and liability, Ind AS simply states that all assets and liability should be recognized at fair value. But as you can say, there are lots of things like contingent liability, intangible assets. You must have noticed. Similarly, liability for income taxes, dues and employee benefits, you must have noticed. Regarding indemnification assets, then similarly you must have also noticed non-current asset held for sale. So these are, and also share-based payment and reacquired rights. These are the things which fall under the exceptions, not necessarily measured at fair value, or not necessarily that they will be measured at proper fair value, because sometime we may have to use some other value. Important thing is that all these things will be recognized and most of the things will be measured at fair value with some exceptions. Correct? So this is the next point. Now while doing the accounting standard says that it is the duty of the acquirer company to determine the amount of non-controlling interest holder. Non-controlling interest holder. Let us say we have acquired 75% stakes on a particular company. Now this is the company. Let us say this is A2 company. Correct? Now 75% stakes are in our hands. So quite obviously 25% stakes are in the hands of some other shareholders. As far as total share capital of A2 is concerned, now we may say 75% is in our hand. Let us say we are A1 entity. And rest of the 25% shares are in the hands of other shareholders, quite obviously. As you know better than I that these other shareholders are known as non-controlling interest holders. Non-controlling interest holder. Why they are called non-controlling interest holder? Reason is that because they have also invested in this particular company. So whenever I am going to invest in a particular entity, I am going to have some interest in that particular entity in proportion to my investment. Suppose if I invest 25% in your company, that means 25% of your net asset belongs to me. Is it clear to you? So when they have made the investment in this particular entity, quite obviously they are also having the interest. But the point is that they are not having the control. That is why they are known as non-controlling interest holder. Is it clear to you? So calculation of non-controlling interest holder simply means on the date of acquisition, we must find out. First of all, we need to find out total net identifiable assets of what we call acquiring company on the date of acquisition. On the date of acquisition, we need to find out total net identifiable assets of acquiring company. On the date of acquisition, what proportion of these net asset belongs to NCI? That is what standard want you to reflect. That means on the date of acquisition, out of total net assets or equity of acquiring company, what proportion belongs to non-controlling interest holder? This is the point. Is it clear to you or not? Later on, when we will move along the lines of these particular what we call intricacies and these provisions, these CO provisions, we will see later on that NCI standard actually gives a choice to the acquirer company. NCI can be measured at PSNA basis, that is proportionate share of net assets basis. For example, on the date of acquisition, total net assets are worth rupees 100 lakhs and presuming NCI share is 25%. So if I will take the proportion of the 25%, proportion of the NCI, which is 25%, and multiply it with the net identifiable assets on the date of acquisition, if I will adopt this methodology of computing the NCI, it will be known as proportionate share of net assets basis. That means I can compute the NCI on the basis of proportionate share of net assets basis. In this case, all I need to do is to simply multiply the proportion of NCI with the net assets of the what we call acquiring company on the date of acquisition. It is very simple. NCI can also be measured on fair value basis. Standard also says that NCI can be measured on PSNA basis or on fair value basis. Correct? In order to compute the fair value basis, it is very simple. We will compute the what we call fair value of all the shares of the acquiring company, all the shares of the acquiring company. Let us say acquiring company is having 100% share capital. Out of 100% share capital, 75% is in the hands of the acquirer and 25% is in the hands of the NCI. And let us say fair value of 100% of share capital is equal to 150. This is the fair value. Now, what will be the value of 25% stakes? If value of 100% stakes is 150, then fair value of 25% stakes will be equal to 150 into 25 by 150. Isn't it? That is 25 into 150 divided by 100, sorry. So this is how you can compute the what we call value of 25% shares. Is it clear to you or not? Yes, sir, absolutely clear. So NCI can be measured on proportionate share of net assets basis method or what we call on fair value basis method. Your first preference should always be for fair value. But problem is that in question generally we will have to use proportionate share of net assets basis simply because we are given the proportions of the NCI, correct? But if question specifically asks you to compute the NCI at fair value, in that particular case you don't have any other alternative. You will have to compute the NCI on fair value basis. So these are the two vital points. Second important point, we will see that NCI is shown as a separate line item under the equity head of balance sheet, correct? Under the equity, we will show it as a separate line item, NCI. Is it clear to you or not? Because in equity, as you must have noticed, we write share capital, we write other equity. Besides that, as a separate line item, we will write NCI also. Is it clear to you or not? And quite obviously, it goes without saying, suppose if I have acquired 100% control of the other entity, in that particular case, no question of NCI will arise. So standard also says that if you have got the control over the other enterprise, you also need to recognize the NCI on the date of acquisition. So in order to compute the NCI, when we say we have to compute NCI indirectly, we are trying to find out actually what proportion of the net assets on the date of acquisition of acquiry belongs to NCI. And that can be done either through PSNA approach, as I just mentioned above, or through what we call fair value approach. However, in practical life, preference is always given to fair value. And while doing the accounting, this is almost your last step. Recognition and measurement of goodwill. It is very simple to compute the amount of goodwill, correct? So that means quite obviously if today, even in practical life, when you purchase something, quite obviously when you return home, you try to assess actually during the transaction actually what happened, whether you lost out or whether you gained out. Similar is the case here when an entity is getting control over the other entity by making a very heavy investment, no doubt about that. So quite obviously we are interested in finding out whether there was capital loss, that is goodwill, or whether there was capital gain. Earlier used to be called as capital reserve. Nowadays, in the jargon of Ind AS 103, we call it gain on bargain purchase. In order to compute the goodwill, it is very simple. First of all, as I told you, you will compute the net identifiable assets. Net identifiable assets indirectly means you will take the fair value of all the assets, subtracts liabilities. So we will have to compute net identifiable assets of the acquiree on the date of acquisition. And from there on, I will subtract the NCI share. Quite obviously, what is left now? It reflects that out of this much of net assets on the date of acquisition, this much of net asset now belong to parent company. So we will get share of acquirer in net identifiable asset of acquiree on the date of acquisition. And now I will compare it with the amount of consideration which we have paid, correct? So against this consideration, we have got this much of amount. Against this much of consideration, we have got this much of amount. So quite obviously, the balance amount will tell us, correct, whether there was capital loss, that is goodwill, or whether there was capital gain, that is gain on bargain purchase. Quite obviously, if the amount of consideration paid would exceed the share of acquirer, correct, in the net assets of acquiring company, so it means actually you have paid more and got less, so it is a loss. It will be considered as goodwill, and at the same time, if vice versa is the case, in that case, it will be known as gain on bargain purchase. Is it clear to you or not? So this is generally the entry which we pass, correct, on the date of acquisition, net identifiable asset. Then we write here what we call to cash. Cash basically signifies the amount of consideration, presuming that we have paid the entire amount in cash. Then we will write the NCI share. And balancing figure would be either goodwill or what we call gain on bargain purchase. Honestly speaking, gain on bargain purchase will arise seldom. Generally, in practical life, we won't come across what we call gain on bargain purchase because, just presume for a while, you have a business. You have a business and the net worth of your business is 300 lakhs. Let us say. Would you sell your business at a price less than 300 lakhs to me? No. No sane person, no sane party would do that or would act in this manner. So that is the reason actually in practical life we would hardly come across what we call bargain purchase. Bargain purchase means when instead of goodwill you are getting gain. Generally such a situation arises very seldom. And it never arises, honestly speaking. It could arise when the other entity might sell its business under some restrictive condition, under some what we call boundation, under some force. For example, there is an entity in UK, let us say. Correct? And let us say Competition Commission of UK suddenly announces that all the entities of foreign origins need to actually move out of the UK within 1 year. And let us say you are an Indian origin company which is operating what we call from UK. Now the problem is that because you are a foreign company in the eyes of UK, you will have to now definitely wind up. So because in this case there is a force, there is a foundation, there is a pressure upon you to wound up. So you might agree to sell your business as per the terms of the purchasing company, and quite obviously in this case purchasing company would pay you little bit lesser amount. So in that particular case, purchasing company may gain. So business gain on bargain purchase generally never arises, but it arises under such a situation. And standard actually clarifies further that in case if you are having a business purchase in practical life, bargain purchase, in practical life, then you must recompute it again. Just see to it whether you have committed any what we call mistake or not. You must make a proper review. So these are the things which we will do. And now we have kept a illustrative question bank, correct? And there are so many sections and so many questions we are going to do. Almost as I've already told you, we are going to cover every example, every illustration, and even test of your knowledge questions. So these are the things which I wanted to discuss you. This is the first session. Hope that it must have must have had come up to your expectation. Looking forward to you very eagerly and keenly to have your feedbacks. So let me know of that so that we can continue with real zeal and enthusiasm. So on such note, we finish this particular session with the promise to meet you again at same time.